Everyone, and welcome to today's Explainer. Look, today we're going to do something absolutely crucial. We are going to completely sever the psychological link between that flashing daily stock price you see on your screen and the actual underlying value of a business. Honestly, if you've ever felt that awful sinking feeling in your stomach watching your portfolio turn into a sea of red, or, felt that intense fear of missing out when a stock just skyrockets for literally no obvious reason, you are exactly in the right place. We're laying down the ultimate foundation for your investing journey right here, right now, so you can stop reacting to the ticker tape and actually start thinking like the true owner of a business. Let's kick things off with a bit of a mystery, shall we? Let's trace the absolutely wild 12-year journey of Bajaj Finance. So back in 2012, this was trading at around 100 rupees. Fast forward to 2020, it hits 500. Then, incredibly, by 2022, it shoots all the way up to 8,000 rupees before kind of cooling back down to around 6,500 by 2024. Now, here is the really fascinating part about all of this. Throughout that entire time, the actual fundamental machinery of this business, it didn't change its identity every single year. The management was solid, the loan book kept growing, the return on equity was robust, and yet the price swung wildly, behaving as if the whole company was radically transforming its core identity from month to month. And that brings us to the ultimate question, doesn't it? It's the exact same business, the exact same fundamentals. So why on earth do we see these wild, unpredictable price swings? This right here is exactly where most retail investors start to panic. They sit there wondering how a stock can bounce around so much if the company underneath hasn't actually changed. It drives people to buy at the absolute peak out of sheer greed and then panic sell at the very bottom out of total terror. But I'm telling you, this anxiety, it just comes from a fundamental misunderstanding of what the stock market actually is. So to fix that, we have to look at this absolute golden rule from Warren Buffett. Price is what you pay, value is what you get. I know, it sounds almost too simple, right? But truly absorbing this one idea changes everything. It establishes once and for all that the flashing number you see on the market, the price, is a completely different animal from the company's actual worth, its value. Think of price purely as an asking price, and value as what the thing is fundamentally worth. They are two totally separate concepts that just happen to occasionally cross paths. Okay, let's just whiteboard this out for a second so we can really see it. Over on one side, you've got price. This is that hyperactive, number-driven by emotion, the 24/7 news cycle and global fund flows. Then on the completely opposite side, you have value. Value is the cold, hard, actual worth of the business based on its fundamentals and future cash flows. Imagine a steady, reliable neighborhood grocery store that makes, say, 5 lakh rupees in consistent profit every year. A reasonable value for that whole business might be 50 lakh rupees. Now, if someone walked up and asked you for 5 crore for that exact same store, you'd literally laugh in their face. You'd know you were getting ripped off because the asking price is completely detached from the reality of the value. But what if they offered it to you in a panic for 20 lakh? Boom! Massive bargain. It's the exact same store, just a radically different asking price. And as an investor, your one job is to just patiently wait until the market offers you a price well below that true value. And this perfectly leads us into Benjamin Graham's timeless wisdom. Graham, who was actually Warren Buffett's mentor, gave us this absolutely brilliant analogy. He said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So what does that mean? Well, in the short term, the market operates exactly like a high school popularity contest. It votes on whatever's trending, whatever has the most hype on social media. But stretch your timeline out to 10 or 20 years. The market turns into a cold, calculating, weighing machine. All that hype just burns away, and it only weighs the real, tangible profits and cash flows. Those crazy Bajaj Finance fluctuations we talked about, that was just the voting machine reacting to short-term noise. But the fact that the stock ultimately multiplied 65 times over a dozen years, that was the weighing machine, eventually catching up and acknowledging the company's massive compounding cash flows. Okay, so how do we actually turn this philosophy into something we can use? Since none of us have a perfect crystal ball, and let's face it, the future is incredibly uncertain, Ben Graham invented what I'd argue is literally the most important concept in all of investing: the margin of safety. Essentially, it's a protective rule that says you only buy when Mr. Market's asking price is deeply, deeply discounted below your calculated value. Why is this so crucial? Because our math isn't going to be perfect. A new competitor might come out of nowhere, or we might just mess up our analysis. The margin of safety is your cushion. It ensures that even if things don't go perfectly according to plan, your hard-earned capital is still protected. Let's put some real-world numbers to this so it clicks. Imagine you sit down, do the math, and confidently calculate that the true, rock-solid value of Asian paints is 4,000 rupees a share. Okay, cool. Now, if the current market price drops to 3,500, well, that's a 12.5% discount. Sure, it's technically cheaper, but it's a pretty flimsy cushion, isn't it? If your math is even slightly off, you could easily end up underwater. But let's say you patiently wait. The voting machine goes into full panic mode and suddenly drives the price down to 2,500 rupees. Now you are staring at a massive, rock-solid 37% margin of safety. That is exactly when you strike. You buy when that cushion is fat enough to absorb whatever unpredictable bumps the future throws at you. Now, Buffett took Graham's deeply conservative approach here and kind of gave it a modern upgrade. He famously said, "It's better to buy a wonderful business at a fair price than a fair business at a wonderful price." What he's telling us is that truly phenomenal elite businesses, companies with massive competitive moats and high returns on capital, they actually require a smaller margin of safety. A top-tier business might only need a 10 to 15% discount because the sheer intrinsic quality of the company will naturally power it forward over time. But a mediocre business or a highly cyclical commodity company, you're going to need a massive 30 to 40% margin of safety just to compensate for how risky the underlying business is. So what are the actual tools we use to find that value? Well, modern finance guru Aswaf Damodaran basically breaks this down into three main buckets. First step is intrinsic valuation, which is usually done through a discounted cash flow model, or DCF. This is where you actually project the hard cash the business will generate years into the future and discount it back to today. Second, you have relative valuation. This is quicker. It's where you compare pricing multiples, like the PE ratio, against similar competitors. It's handy, but it heavily relies on the assumption that the market has priced the other guys correctly. And third is asset-based valuation, which is basically looking at what the company would be worth if you liquidated it, just adding up the assets and subtracting the liabilities. In reality, most serious investors use a combination of the first two to kind of triangulate the truth. Let's peek under the hood for a second, because finding true intrinsic value isn't just about throwing darts at a board. It requires tracking rigorous historical data. Take the implied equity risk premium, for example. In plain English, this premium is basically the extra juice, the extra return that investors demand for taking on the headache and risk of the stock market rather than just parking their money in perfectly safe government bonds. By reverse engineering these numbers from what the market is actually paying today, we can actually quantify the exact level of risk and expected return that is baked right into current prices. And honestly, it goes even deeper than that. Valuation requires you to deeply understand the macroeconomic gravity that a business lives in. And what is that gravity? It's interest rates. It's fascinating how inflation and risk-free treasury bond rates mathematically dictate value. Think of it like a seesaw. When risk-free rates go up, the present value of those future cash flows drops, pulling intrinsic values right down with it. You just cannot successfully weigh a business without understanding these massive underlying economic forces pulling on its cash flows. All right, before you run off and start hunting for value, I really want to play the older brother here and warn you about some classic retail traps that absolutely wreck portfolios. Trap number one, assuming that a low PE ratio or a stock dropping 50% automatically means it's incredibly cheap. Trust me, often the underlying business is just dying, and the actual value was destroyed right along with the price. Trap number two is anchoring. This is when you assume that just because a stock used to be at 500, it's a steal at 300. The market does not care about past prices. They are completely irrelevant to future cash flows. And finally, the worst one, going all in on one high-conviction pick. Guys, even the most rigorous value analysis can fail. Diversification, paired with a rock-solid margin of safety, is your only true protection. So, as we wrap up today's explainer, I want to leave you with a really crucial, kind of self-reflecting question. Something to keep you totally grounded the next time the market panics or, some crazy euphoric hype takes over. You probably know the exact price of your portfolio right now. I mean, you probably checked it on your phone this morning, right? But do you truly know its underlying value? Because until you can separate that short-term voting machine from the long-term weighing machine, you're always just going to be a passenger to Mr. Market's wild mood swings. In our next explainer, we are going to dive deep into the actual math of how we calculate that underlying value by exploring the cost of capital. But until then, keep your focus on the value and let the price serve you, not the other way around.